All right, everyone. It looks like we are at time. My name is Jeremy Kleins. I'm with the NACVA and the Consultants Training Institute. Before we get started with today's Around the Valuation World International webcast, I wanted to go over a few housekeeping items. First, to obtain CPE credit, you must answer all poll questions that will pop up on your screen during this presentation. If you have an AVW subscription to the international version of Around the Valuation World, you will receive a CPE certificate within 7 to 10 business days after today's webcast. If you have any questions during today's webcast, please use the Q&A format feature in Zoom, as those will be directed to the panelists. If you have any questions about NACVA or any technical questions, you can contact me through the chat feature as well. With the AVW and AVW International webcast, we try to cover the current trends and hot topics in the industry. However, with the 1 hour time frame during this webcast, we're not able to cover all of the topics. So there is a link to some additional resources that will help you, that will allow you to stay updated in the industry as well. And those things are in your material. And I would like to go ahead and share a video with you. If you'll give me just a second here, I will get that switched over. Full screen, and I believe you should have audio.
Windy Street is a prominent outsourcing firm in India that offers a comprehensive suite of services, including valuation, financial due diligence, accounting, auditing, and tax. Founded 3 years ago, with a clear vision to provide exceptional services to professional and accounting firms, we now proudly serve over 15 clients. Our success is built on our unwavering commitment to the values of trust, quality, and people. Our team of over 150 skilled professionals is led by a highly experienced leadership team. We bring unmatched expertise and dedication to every client relationship. At Windy Street, we believe in putting people at the heart of everything we do, our clients, our team, and our community. We also prioritize complete security and a robust IT infrastructure, ensuring that our clients' privacy and data are safeguarded at all times. With Windy Street, you're not just a client, you're a partner in a journey toward excellence.
All right. With that, I am going to go ahead and turn it over to Wolfgang Niest, and I'll let him take it over from here. Thank you, everyone.
Thank you, Jeremy. Welcome, everybody, to our first Around the Valuation World International show this year. And yeah, even though it's already January 20th, I don't want to miss the chance to the opportunity to wish you a happy new year. All the best for 2025 as well. Today, it's a pleasure for me to introduce David Goodman. He's MBA, CPA, CVA Emeritus. He's retired in Norfolk, Virginia. David has 25 years of experience in performing business valuation and forensic accounting service for family law and business disputes. David also has prepared business valuations for tax and buy-sell purposes. He also has an MBA from Amos Tuck School at Dartmouth College. David is past president of the NACVA Mass State Chapter. He is also past chair of the Massachusetts Society of Certified Public Accountants Litigation and BV Committee. He presented on business valuation and tax issues related to divorce to the NACVA National Convention, NACVA Mass State Chapter, the Massachusetts Collaborative Law School Council, and BV Resource. David has authored and co-authored articles for the Value Examiner, Quick Read, and Business Valuation Review. And he also testified as an expert witness in court and arbitration. Having said this, we come to our today's topic. And thank you, David, for joining us and giving a presentation on, one of the most subjective topics in business valuation, a hybrid approach to determining the company-specific risk premium with Monte Carlo simulation. This is based on an article published in the Value Examiner in end of November, December 2022. And as a member, you also have access to this article. But for me, it's much more interesting to hear about the story and to see how you can, bring a little bit more objective view on this subjective topic. So having that this, I hand over to David. Thank you, David.
Okay. Hello, everyone. And do you all now see my screen?
Yep, perfect.
Okay. Today I'm going to be talking about, this is a condensed presentation. It was originally designed as a 2-hour presentation, so I'm doing it at about half the time. So if there's some gaps in my explanations on things, I apologize, but you will have my contact information and feel free to contact me if you want to find out more about what my thinking is that I'm not able to convey here. I'm proposing a hybrid model using a modified version of the risk rate component model and the multi-attribute utility model to derive company-specific risk premium. And that's sort of going to be a base model. And then a second, more complex model is when I incorporate Monte Carlo simulation in the model using something called triangular distribution. And today, I want to put company-specific risk in context of valuation theory and practice. Those of you who read Quick Read may be aware or may not be aware that me and Malcolm McClellan have written 4 articles on the implied private company pricing line and how that relates to a testable, empirically testable business valuation theory. I don't think this is inconsistent with that, because in implementing the methodology that theory suggests, you still need to determine a company-specific risk premium. The other thing I want to mention is if there are people who are not in the United States, that I'm talking about, referencing here, we reference New York Stock Exchange data through various databases. And, but you would, however you develop your equity risk premium, the company specific risk is still something that I imagine you have to add on. And I want to talk about why we do that, because I think a lot of people have lost sight of why we do that. I'm going to discuss my new approach to determining company-specific risks, and then I'll show how to incorporate Monte Carlo simulation. So one of the things I like about this is I think this approach is defensible. It shows how your company-specific risk premium has been calculated. It is a new concept. I mean, I first wrote about it 2 years ago in the middle of COVID. I'm not sure how it's been received. This is my 3rd presentation on the topic. I had a lot of people ask for copies of my spreadsheets from the articles they've read. One of the things I'm concerned about with our industry in the United States, I don't know how it works overseas, is that we have rules of evidence, and the rules of evidence tell the judges that they're only supposed to accept testimony that's either empirically testable or is basically standard practice, has been accepted by the industry. And my fear is that the judges being, forgive me if there are any judges online, I'll just say very busy, tend to take the path of least resistance, and that might make it difficult for business valuation experts to introduce new methodologies. And finally, what I have to say today is not the opinion of my firm, Justin Oslin and Associates, GACVA or NACVA, and I'm presenting it for your discussion and your review. So if we were interactive, I'd ask for a show of hands, but what size business do you value? Most of us who value businesses aren't doing the size businesses of the people who contribute to Hitchner's financial valuation, or Roger Grabowski or Chris Mercer or others. I need to move something out of here because it's blocking my screen. There we go. In my practice, I valued businesses generally with revenues under 3 million, if not 1 million. The occasional $5 to $15 million business. I think the largest I ever did was a $75 million business. And these businesses are, small businesses are very different from large, closely held businesses and publicly traded companies. So I developed a model for small businesses that I valued, something that would work for me and hopefully others. Whether it could be applied to the larger companies, I don't know. I don't value them, so I don't want to be as presumptuous as to say what would work for them or not work. The other thing about this model is it's not for extraordinary business risks. So, for example, I had some restaurants we were evaluating that their lease, whether they were going to be able to keep their lease or not, was in question. And so we were using, really high risk rates on those valuations, like 30, 40%. This model is not intended for situations like that. So we know that small businesses are different from our middle market and publicly traded companies, but we do use public market stock data. And the question is why? And to this, I turn back to the basic principles of economic value. Ray Miles set these forth, I think, in a nice discussion in Basic Business Appraisal, a little paperback book, published in 1984, 3 Principles of Economic Value. And these are kind of obvious, intuitively obvious, as they used to say in business school. But I think a lot of business valuators lose sight of these principles and as to, why are you doing what you do? And the first is the principle of alternatives. And this states that in any contemplated transaction, each party has alternatives to consummating the transaction. That's kind of a duh. You have a pocket full of money, you have different things you can spend it on. So, for example, rather than investing in the subject company, an investor could invest in a small cap EFT. When we use publicly traded market data to establish discount rate, we are invoking this principle of alternatives. The alternative being to invest their funds in a publicly traded investment portfolio. The second principle of business valuation is the principle of substitution. And this states the value of a thing tends to be determined by acquiring an equally desirable substitute. Ray Miles used this to justify the market approach. We're trying to find what an equally desirable substitute in the market might be for a similar company. But if we're using the income approach and we use publicly traded company data to value the company, then the question is, how do we make our subject company an equally desirable substitute? Because when we use that public traded data, we're effectively saying our alternative is to invest in a publicly traded portfolio generating public market returns. So somehow we need to account for the increased risks of an investment in a small privately owned company compared to an investment in a publicly traded portfolio or EFT. So one way we do this is using the build-up method to determine the discount rates. So we begin with our publicly traded small cap rate. If we're using the size premium, the 10th decile or 25th decile size premium, and then we add to that company-specific risk premium. And this is the additional return required to make an investment in the subject investment company equally desirable to an investment in the small cap publicly traded portfolio. So now we're consistent with the principles of alternatives and the principle of substitution. The final principle of economic benefits is that economic value reflects future anticipated benefits. So when we analyze our small company for company-specific risks, we are analyzing the risks as they may impact future anticipated benefits. So our company-specific risk premium is actually doing 2 things. One, We're determining the required rate of return for the risks involved, but we're also trying to make our company an equally desirable substitute to a investment in our publicly traded market portfolio. So when we look at the company-specific risk premium and the methodologies for that, I didn't have time to go through the various methodologies, but there are various subjective methodologies we use. But there is no generally accepted methodology for determining company-specific risk premium, and it's based on our professional judgment. And this is a bit of a problem for those of you who are new to business valuation. At one time, the expert's testimony consisted of, in my professional judgment, the value of the business is X. Thank you, sir. And that was that. Now it's a lot more involved. We have a lot of methodology we follow, but it still requires professional judgment. And that's because valuation is a craft that requires use of quantitative and qualitative analysis and professional judgment. Our professional standards say that if we don't invoke professional judgment, we're not doing a valuation. And if it ever becomes purely quantitative, then where's the need for professional judgment, and our work can be performed by computers? Hello, AI. So, but before getting into company-specific risk premium and how we develop it, I'd like, I'm now going to say, okay, why are we making such a big deal about this? Because in reality, it's not the major contributor to our value in terms of what we come up with. This is just a simplified, build-up method using public market data. We have 15%, add a 5% company-specific risk premium, 20% discount rate. Well, the company-specific risk premium is 25% of that discount rate, but the public market data is 75%. So already we're dealing with a much smaller movement of our value. Basic valuation calculation, then let's look at the sensitivity. So we start at 5%, and if we drop our company-specific risk premium, say, oh, well, what if it's 4% or what if it's 6%? We're still, I'll say, plus or minus 5%. And if we drop down 3%, 7% from 5%, we're still, I'll say, within, 10%. So, what we do is not that accurate. So the difference between 3 and 5% or 5 and 7% is probably, for the small companies, not enough money to get hot and bothered about. Though I know evaluators who will, and lawyers who will. So criticisms of the subjective methodologies, and this is in the United States. There's primarily a case from the Delaware Chancery Court in which the criticism was that the subjective methodology didn't explain how the magnitude of the company's specific risk premium was actually determined. So if the valuation expert on one side uses a risk factor of 7% favorable to their client, and the other expert uses 3%, then what's that look like to the court? So obviously, if one person says the value is $625,000 and the other says it's $500,000, we have a $125,000 difference. At a divorce case divided by 2, we're still talking, serious bucks to the parties. So, but we don't have to have something that looks like it's pulled out of the air. And there's some tools in Hitchner's book. There's an appendix, an addendum. It's available online, called the risk rate component model. If there are any ancient members of GACVA on here, like I am, this is similar to the green-black model first proposed by NACVA. But in this model, they have a bunch of different categories of risk. And under each risk, they have a bunch of attributes. And they assign a risk indicator. And you can see these are all over the place. And they weight them, extend it out, and then come up with a weighted average. And then for each of those groups, add up all the weighted average premiums. And they come up with what the proposed discount rate is. This doesn't refer to public market data at all. And I don't think many of us, if any, use this methodology. But the concept behind it can be useful. So I'm proposing that we use a modified version of this and combine it with a multi-attribute utility model to derive company-specific risk premium. You may be familiar with multi-attribute utility theory from David Wood's MUM for allocating goodwill and personal and enterprise goodwill. It's still largely a qualitative analysis, but it does show how the allocation of personal and enterprise goodwill was calculated. And David called this MUM because he thought if he used MAUT, multi-attribute utility theory, people would call it MUT. And he didn't want it called MUT. So he used MUM. And it's a decision-making theory where you can have certainty or uncertainty in the outcomes. You have a number of attributes, and some of these attributes may be considered more important than other attributes. And certain attributes may be more likely to occur than other attributes. And if you think about it, we use this conceptually all the time. I'm going to buy a new car. How much money do I want to spend? How reliable is the car? What's my image in driving that car? And so forth. And we will weigh all those factors and decide what a car was. I want to go out to dinner. What kind of food do I want? How expensive is it? What kind of atmosphere do I want? So forth. It's a model that's used in the social sciences, but I think it's very easily adaptable to what we do. And the way David Wood adapted it is he said, okay, we have the attributes and we assign importance to those attributes. How important are they to creating goodwill? And then to what extent do those attributes exist? And then he uses a range of potential outcomes to determine what the appropriate percent goodwill is for personal or business goodwill. When we apply this to the company-specific risk premium, we're going to consider the importance of the attribute to our subject company in terms of how it influences the future earnings. And then we're going to consider the extent to which that attribute increases risk. So, for example, we may determine that one attribute very important to the company is customer concentration. And the more concentrated the customers, the higher the risk for that company. So the weighting is represented by IU, and the extent to which the attribute is considered to increase risk is represented by EU. IU times EU is the multiplicative utility, weighted contribution to risk, and then we add up all those MUs and we get total multiplicative utility. So let's just look at an example of what I'm talking about here. I developed initially a spreadsheet with 36 attributes grouped into 7 different categories of risk. This is just one of those categories. So we have other company risks. This is the IU. How important is it to the company? This is the EU. To what extent does it increase risk? We take 3 times 1 to come up with our multiplicative utility of 3, add them up, and we have our subtotal multiplicative utility of 32. Add up all these and we get a total multiplicative utility. So if you look at this above table, you can see the total is 32, but I only have 5 attributes. So if you were to start inserting a lot of lines in here and say increase 10 attributes, then this total of 32 was probably going to be something very different, something higher. And it's important that we don't do that on the spreadsheet because we're going to use a range of outcomes, and I'm going to show you how that works in a moment. Because the range, changing the range of outcomes and increasing the number of attributes could change this multiplicative utility score, and our range of outcomes won't work. So what am I talking about? So here's a table here. In this case, I just have 5 categories of outcomes. A score of 0 to 150 results in a company-specific risk of 1%. 150 to 175 results in a company risk of 3%. 175 to 225, 5%. 225 to 275, 7%. 275 to 99, 9%. Oh, what happened to 2, 4, 6, and 8? They're not there, are they? No. In my mind, one I showed you in terms of the sensitivity, there's not a big difference between 4 and 5 or 5 and 6. And we're not that accurate in what we do. So, if we have, and the other reason I don't have it is if you have too many categories here, these ranges get too narrow. And one of the things that people don't like about methodologies like this is the attorney walking you through back up here and say, well, what if you change that 3 to a 5? What if you change this 1 to a 2? And so forth. That, would that result in a different answer? Well, the answer here is no, because small changes like that won't kick me out of the range. It might if I'm sitting at 176, but generally, as long as I'm well within these ranges, it's not going to change my outcome. So one of the things I did is, I think what I'm going to do now is I have to stop sharing the screen a moment and share a different screen. I'm going to show you the actual spreadsheet. And find this. And I'll get back to Zoom. Okay. There we go. Sorry. Share.
David, we cannot see your. Oh, no.
Okay. Yeah, it took me a moment to find the right. Now I got to get to the right spreadsheet here.
Okay.
Okay, here we go.
David, could you please turn on your camera? I think it's shut down.
Okay. Can you see my screen now?
Yeah.
All right. I'm going to make it a little bigger if I can.
Okay.
Okay. Is it easier to see now?
Yeah, it's good.
Okay. So this is my 5-range model. This is my table. And here are my IU weights, 1, 3, and 5. 1 being less important, 5 being most important. Here's the risk, 0, no risk, positive attributes. And then I have low risk, moderate risk, high risk, very high risk. And this is an example of the categories: financial attributes, what it is. Over here in the comments, I put why I have the rating that I do. And we come down to the bottom here, and I add up all my multiplicative utilities as 292. And this here is a basic lookup function. And my 292 falls in category 5, so my company-specific risk is 9%. So one of the things, there are a couple questions that I got back on this when I first put it out. One was someone said, you don't have any negative risks, like you don't have a -1. And my thinking on that is there's no way my subject company can ever be less risky than a publicly traded counterpart in any particular attribute. The best I can do is have no risk. But if you think that you should have a -1, you could change these numbers to incorporate a -1. That's up to you. The other question that came up was, well, how did you determine the ranges on these tables? So what I did is for each of these numbers here, there are 36 attributes. So in total, I have 72 different possible number combinations in terms of blocks of numbers here. I have 36 IUs and 36 EUs. So for each one of these, I put in a random function on each block to determine, randomly pick 1, 3, or 5, and over here randomly pick 0 through 4, and ran that 2,000 iterations and said, what was the distribution of my outcomes? So I'm going to close this worksheet now, and I'm going to stop share. And I'm going to share again and go back to my presentation. So am I sharing my presentation now?
Yes.
Okay. So this was the distribution. And you'll notice it's heavily weighted at 5% and 7%. Now, that wasn't by accident. I think we all have our biases as to what we use for company-specific risks. Mine is 5%. That's my starting point. So I developed these ranges I wanted to see that, okay, most of the time I will end up at about 5%. If you think differently, you could play with the ranges, do that similar type of analysis, and come up with your own ranges. For example, some people use Kroll, and so they tend to be lower down here. I do not use that methodology. So just to review, this model does not address exceptional risk situations. And one of the criticisms of the model is, well, if an attorney does go through and say, what about, if you change this number to this and goes through all 72 numbers that way, this is what you end up with. So now I'm going to move on to the new model, which is Monte Carlo simulation. And let's just talk about that a moment. Monte Carlo simulation models probability of different outcomes that cannot be easily predicted due to the intervention of random variables. So it's used to understand the impact of risk and uncertainty. Developed in the 40s by scientists and mathematicians working on the Manhattan Project. If you're not familiar with that, that was the project in the 40s that developed the atomic bomb. And with the Monte Carlo simulation, we can incorporate uncertainty into our financial model. And we just have to identify a variable that we're going to make random. And then we can run multiple simulations, and we average the results to get that. So let's look at this a little further. In Excel, you have a rand function, and it will generate a random number between 0 and 1. So what I did was I took a moving average of it over 500 iterations and plotted them out. And you can see here that at around 250, we start to level out. And by 500, we're pretty level. So the people, so if I'm only using one random number in my calculations, the people who say, you got to use 10,000, no. The more random variables you use, the more iterations you have to run to make it stable. But for what we're doing here, 500 iterations is more than enough. And I mention that because you'll see us and how we develop our worksheet, it can make the worksheet pretty cumbersome to add more iterations. The other thing we have to give thought to in Monte Carlo simulation is how uncertainty might vary and whether we expect the risks to be symmetrically distributed or skewed. So if we look at the distribution of random numbers, this is over 500 iterations. You can see they're pretty even. They'd be more even if I ran at 10,000 iterations. Then we'd probably have a nice flat straight line across the top. But they're pretty even. So when we build our model, let me come back here. If they're pretty even, and I build a model that says my company-specific, my total multiplicative utility can vary up or down by the same random factor, I'm just going to end up back at that multiplicative utility number. There's no point to being random about it because I know I'm going to end up back there. So we need to give thought to whether we need to be skewed. And a skewed distribution is one where the chance of a higher outcome is greater than the chance of a lower outcome, or the chance of a lower outcome is greater than the chance of a higher outcome. So how do we do that? Yeah, what's going on here? Behavioral economists use something called loss aversion theory, also known as prospect theory, to explain investor behavior. And what this says is there's a phenomenon where real or perceived loss is psychologically or emotionally more severe than the equivalent gain. For example, the idea that I might lose $100 is much more painful to me than the chance that I might win $100. Gambling casinos would argue against this, but this is in terms of our how it impacts our buyer. It means that a potential buyer of a business is more likely to place greater weight on negative risk factor than a positive risk factor. And I think this is an assumption that we largely live with. That's why we're concerned with risk in the first place and trying to figure out what a buyer might be looking at. And when we do due diligence, the buyer's not looking at for what's right, they're looking at for what's wrong and why they may not want to believe the numbers they're seeing. So the degree to which company-specific factor is weighted isn't symmetrical. So recall we have the IU, the important utility, the range was 1, 3, and 5. So for example, supply stability has an attribute of 5, meaning supply stability is very important to the company being able to produce it. The EU is, okay, to what extent does supply stability impact the company's risk? So in this model, I changed from 0, 1, 2, 3, 4 to 0, 1, 2, 4, and 7. So notice that as we get higher in risk, the gap between increases. We go from increase of 1, increase of 1, increase of 2, increase of 3. So 0 being no significant risk, 7 being very high risk. So let's look at an example of how I might apply this. So this is in the middle of COVID when I did this. So the company we were valuing, there's a lot of instability in the supply chain, as we recall. But thus far, this particular company's been able to attain the product it requires. So we decided that the most likely supply chain risk is 4. However, there's a chance that the supply chain could become totally disrupted, in which case the risk factor would be 7. That's the high range. There are also signs that the supply chain would improve and the supply would become more stable. And in this case, the risk would be 2, low range. So the above weightings place greater weight on the possible negative outcome, +3, than the possible positive outcome, -2. So we can perform that analysis for all of the attributes if you want, but that's going to be pretty time consuming. So what I focus on are what are particular attributes that maybe are uncertain or most uncertain and are important to the company. If the importance is 1, I'm not going to worry about it. If the importance is 5, that's where I'm going to focus. And some of those things could be weakness in management, lack of long-term lease, supply chain concerns, whatever. So as a result of this analysis, you end up with a most likely outcome, worst case outcome, or best case scenario. And this is essential when we're going to apply Monte Carlo simulation to the model because we're using something called triangular distribution. And a triangular distribution assumes upper limit, which is our best or high case, a lower limit, worst or low case, and a mode, most likely case. So the triangular distribution has a definite upper and lower limit. So we are going to avoid unwanted extreme values. Keep in mind, this is not for extreme risk situations. It works moderately well. It works well with moderately skewed distributions. I'll talk about that a little bit more momentarily. And you don't need to know the mean or standard deviation to use this because what we're concerned with are our best case, worst case, and most likely case. So one criticism is that it doesn't work very well with distributions that are very skewed. So for company-specific risk analysis, we shouldn't be extremely skewed in most circumstances, meaning you're not trying to choose between a 3% and a 15% company-specific risk premium. You can be much more narrow than that. Another criticism is that it's designed to peak on the mode. Well, yeah, that's our most likely scenario. So isn't that the one we want it to peak on? So I'm not going to attempt to explain this formula. It does work, and I'll show you how I was able to verify that. This is the formula for Excel. And you can also download an add-in which calculates this called NTRAN. One I found is NTRAN, it's free. And so just to review, when we apply Monte Carlo simulation to our worksheet, we're actually going to do this with three separate tabs in our workbook. Let me get rid of this. The first is what the evaluation analyst thinks most likely outcome. Second is the worst case scenario. The third is the best case scenario. When you're doing this analysis, remember, you're only varying the EU. The IU, the importance factor of the company, shouldn't be changing. So for the Monte Carlo simulation, I use a 9-range outcome. Remember, a 5-range model was used initially. And this is because the sensitivity testing is implicit in the Monte Carlo simulation, and we don't have to worry about a small change resulting in different outcomes. We're going to be, by randomly changing the total multiplicative utility, we're saying, what if we change all these numbers in here and have different total multiplicative utilities? What's going to be our outcome? So here's my table. You'll see now we have 1%, 2% through 9%. Notice the ranges are much more narrow because we have more categories. And I ran the similar random analysis to say where, what will be the most likely outcomes. And here the range is, sort of in the 4 to 7% range. But as you'll see, doesn't mean that I'm not going to have a higher risk factor using this model. Just depends on what the circumstances are for the company. So in this particular case, our low risk was 285. Our most likely outcome was 410. Our high is 509. This is our random number. We run 500 iterations. To do this, I'm going to show you the spreadsheet in a moment, but you create a table using what if analysis data table. And then in your spreadsheet, you're going to create rows 1 through 500. Your formula, this references that triangular distribution formula. And this is a dummy cell in C9 for when you create your table. And what it does is it randomly drops in numbers that are randomly calculated using that formula. You can see the total company specific risk premium is varying. And this is a distribution of one of my runs, outcome 500 iteration. See how it's shaped like a triangle? And in this case, the 410, which was my most likely outcome, it's skewed slightly to the right with 425 being higher. So I have 500 observations. My average was 401, standard deviations 46. Compute the standard error is 18. You may recognize this as 3 standard deviations. And so I multiply standard error times this, subtract it from my mean, add it to my mean. I get a range of 7 to 8%, 95% certainty that my outcome is going to fall within this range if I play around with all those calculations of the total multiplicative utility, the way an attorney might want me to. So, let's look at our model now. I have to stop sharing again. Let me enlarge this because when I stopped sharing last time, I lost it. And now I want to share again. And let me find my spreadsheet. And I'm sharing. So are you now seeing my spreadsheet?
Yes, we see your spreadsheet.
Okay.
David, could you switch on your camera? I think
Is my camera off?
Yeah, it's off.
Oh, I apologize. Let me blow this up again. Where'd you go? Okay.
Yeah.
All right. I'm sorry. Didn't know it got switched off. Okay, let's move this out of the way. Let's find my worksheet again. Okay, so I put in an explanation of the workbook. Note number 11 here. You're on your own. So here I have the most likely outcome. Here's my table. It's similar to the other spreadsheet you saw. Here are my notations. In this spreadsheet, I actually put in some conditional formatting so that if I put in a number that's not consistent with this, it tells me. You can look at if you don't know conditional formatting, you can read how to do that. It's built into this spreadsheet here that I think you're getting a copy of. I put in my explanations, and then I have my result down here, and then I go to the low. I have a different calculation. What I didn't do on this worksheet, but I did do in a quick read article, which I'll tell you which one it is. I would normally what I would do here is I would highlight over here all the items that I'm looking at that are uncertain. And then over here, I would highlight them again and have an explanation for just that item and why I'm changing my EU on that item. And then here I have the high return 509. And this is the Excel worksheet. So this number here with the line through it just means that the worksheet is set up to not automatically recalculate. So that's telling me I have to recalculate that manually if I want to recalculate it. That's a new feature in Excel. I don't know. This is the formula I showed you in the slide, and here it is here, actually, as it is in Excel. This is my table referencing this formula up here. And this is my outcome here. Here you can see, boom, 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 boom. This goes down 500 columns, 500 rows. This is a distribution, skewness, kurtosis. There it's graphed by those particular buckets. This is my calculation. So you can see here, my range is 7 to 8%. And over here is the NT-RAND model. And you'll notice the outcome here is very similar to my outcome here. They're not exact because we are generating a random number. They probably would equal if I did more outcomes. And the formula here you can see is referring to NT-RAM, which is a download. But having both these on here means that, if I'm asked on the stand, well, how do you know your Excel calculation is correct? Well, here I have this. How do you know this is correct? Well, this agrees with it. So that's basically how this spreadsheet works. The other thing I did do is you want to look at the distribution. I created something where I can have more brackets to see what the distribution actually is looking like. With more brackets, I did the same thing in the Excel spreadsheet to see what my distribution looks like. NT-RAND uses a different random number generator than Excel. I'm not sure how that works. So this is these are the basic models that were developed. So let me stop share here. And these spreadsheets are available to you for free. I'm not trying to make any profit off this. I'm just trying to share it with the world. Are you seeing my screen now? My slide presentation?
Yes.
Okay, thank you. So with this model, you're able to show the considerable thought you put into analyzing the risk relative to your company. Even if you just use the simplified model, you're able to show that. You're able to show that there's 95% certainty that your result will not fall outside of the given range, given your 3-risk analysis. And this neutralizes the nitpicking of individual IUs and EUs that valuation analysts might be wary of. With this model, remember that it's intended for small businesses. It's not intended for unusual risk situations. So where can you learn more about this if you haven't? So the first article was published in the Value Examiner in August 22, July-August issue. We referenced this one is where I talk about the hybrid approach. Then in Quick Read, I talked about the hybrid approach. And I did a second article in Quick Read. And this is the one where I actually did a case study, an actual case study of showing how I did the three different scenarios for this. If you want a copy of the spreadsheet, is here. I see that I'm going to stop screen share because I want to get the chat. I see there's some questions in chat. I want to take a look up. Oh, what dollar amount are the ranges in? I think they're in thousand. No, hold on. These ranges are 1,000, 150,000 to 170. I'm sorry, these ranges here are actual. They're the total multiplicative utility in here. They're not in. These are not dollar amounts.
Maybe David, you can share your model again.
Oh, sorry. Yes.
It's already not shared.
Thank you for bugging me on that.
So the question was, can you
can
explain the
tell
ranges?
I am not a sophisticated presenter on Zoom. So these ranges here are not dollar amounts. They're the total multiplicative utility that's calculated from the spreadsheet. So these are just actual numbers here. In doing the company-specific risks, this does not involve dollar amounts at all, other than it's geared for your smaller businesses. And right now, and the reason I say it's geared to small businesses is because that's what I know. If you value large businesses and you think this might work for it, fine. I'm just not. I don't feel comfortable saying, "Oh yeah, go ahead and use it," because I don't value those size businesses. It's not my area. Would the Monte Carlo simulation work in Python, now integrated a bit with Excel? I'm afraid I don't know what Python is, so I can't answer that. How much detail regarding the Mote and Monte Carlo process do you add to a non-litigation related report? Additionally, how you use this value in direct testimony and how was it received by a finder? Okay, let me answer this. This is multiple questions. So first, I don't write, I actually never have called a report a detailed report. I write summary reports, but my summary reports might be close to a detailed report. And a non-litigation related report, I have like for tax, gift tax purposes, I have included the spreadsheet. I'm getting ready to do one, and I might include, I would probably, I'm not sure what I will do there in terms of the Monte Carlo simulation. In litigation reports, often what I will do is just say what, I won't even address, I will say what the major risk concerns were that I considered in the company specific risk premium, but not throw that information out there. And but be ready to defend it if I need to. I've actually, while I haven't done a lot of testimony in trial or arbitration, I've actually never really been challenged on company specific risk premium. It's always been more focused on things like reasonable compensation and other income issues. So no, I have not used this in direct trial testimony. I developed this actually during COVID, and at the same time, I stopped accepting litigation engagements on philosophical grounds. My work was largely in the divorce arena, and I worked in the state of Massachusetts in the United States, and I felt that Eastern Massachusetts, and I felt that I was aiding and abetting a ridiculous system where attorneys were able to run up outrageous legal fees over things they shouldn't be. Why limit the risk range 0 to 9% if we would select from 0 to 5? Yes, the result would be different. And this, you can modify, as I said, you can modify this table range to fit with what you would like. I would suggest that if you do that, you do the type of random analysis that I did and see what the distribution is to see if it's going to work for you. My bias, as I said, is, I before I did this, when I did it subjectively, I always started at 5% and said, is there something that's going to increase it above 5% or below 5% and work from there? So that's kind of where I built this table. But yeah, you could. Okay, and the email. I think
David,
you all are going to be. Someone's asking for
David, it's Andrew Newman. May I just ask a quick question?
Yes.
In the family law arena, how receptive were the mediators and arbitrators to your models?
I never presented this there because I never had the company specific risk premium challenged. I mean, in some cases we did have issues where the company's specific risk was just outrageous, but there were so many other problems with the report, it never really got that far.
Thank you.
So last
Oh,
slide.
David, there is another question in the chat. I will read.
Yeah, hold on. Someone was just asking for the that form.
The email, yes.
Okay, there's my email address. Email address again. Okay.
Yeah, the question in the chat was, what do you think about an alternative approach where you model out several potential future cash flow scenarios for a company and then use Monte Carlo simulation to back solve for the resulting company-specific risk premium?
I'm not sure I fully understand the question. In terms of this, I think, I mean, there are two things that go on here and what we do. One's determining the future cash flow. And depending on how you determine the future cash flow, sometimes people use weighted average cash flows and assign risks to the cash flows. I typically didn't do that because in Massachusetts and the divorce arena, the way the judges are locked into how they think a value should be determined, which is the average of the historical earnings. The judge is not understanding that irrespective of how you average the historical earnings, you're still forecasting future earnings. We didn't really get into weighting average cash flows for them. So this model was developed sort of based on my experience with dealing with them and how we do valuations for them.
Okay, thank you, David. So Jeremy has shared the models again. So any questions?
One other comment is if you find errors in the spreadsheets, I apologize, let me know. As I said, I'm putting this out for people to look at and see what they think of it. If they like it or want to modify it as their own, they're free to. There's no copyright on any of this other than what's been published by NACVA and BVR. And I'm not trying to make any money on these models. I'm just trying to see if we can come up with a tool that will get us less subjective and address some of the concerns that the courts have expressed about how we develop this company-specific risk factor and come up with something that'll make it more defensible and more credible.
Yeah, thank you. Thank you, David.
It
for your
looks like
insights.
we might have 2 questions or 2 hands are raised in the chat. So, Jonna Menifee, did you have a question? And Jill Aquino, both of you had your hands up. Did either of you have questions? Well, maybe not.
I can't see any questions in the chat anymore.
All right, I think we're good then.
Yeah, thank you. Thank you, Jeremy. Thank you, David, for this insights. Yeah, hope to see you again in 4 weeks. We have the next Around the Valuation World International Show on February 17th. It's also on cost of capital, also on smaller companies, and the speaker will be from Italy, Federico Beltrame. He developed an alternative model, besides the CAPM world, and he will show you his research on these cost of capital for private companies as well. So similar topic, different way to deal with the risk topic for private companies. Thank you, David, again. Thanks to all for your interest in the show, and hope to see you in 4 weeks. Thanks, David.
Thank you, David. Thank you, everyone.
Thank you, David.